we're getting another closely watched jobs report in just under 2 hours. Expectations are for the unemployment rate to rise to 19.5% and for a decline of about 8 million non-farm payrolls. Joining us right now to talk about it, Michelle Girard, Chief U.S. Economist and Managing Director at NatWest Markets. Also, Stephen Parker, J.P. Morgan's Private Bank Head of Advisory Solutions. Good morning to both of you. Michelle, I'll start with you. We've all been debating what the number is going to be. To some degree, my question to you is actually how relevant is the actual number this morning?
Well, I think, Joe was saying earlier, as well as Becky, the number will be watched, no question. But to some extent, it's old news. This is a snapshot of where we were in the middle of May. And, as the economies across the country are beginning to reopen, this may or may not reflect, where we stand today, the extent to which so many of these individuals who were reported to be out of work in the middle of May have started to be rehired and reemployed. So, I do think it's important. I think the message will be that the worst is behind us. I think it will mirror the ADP report in that way. And in that sense, I think it will be, will be welcome news, even with another decline reported. But again, I do think the markets are likely to look through this in either case.
Stephen, what's your number? And more importantly, what do you think it's going to suggest or even tell us about the depths of this situation, or more importantly, how quickly things come back or not?
Yeah, I'll leave the number to the Economist. I don't have a specific view on today's report, but I think what Michelle said is the most important thing. I don't think markets are going to be too focused on what is clearly going to be a really bad number. I think what markets are going to be more focused on is the path forward and really watching some of the more real-time data around consumer spending as the economy begins to reopen. If anything, if the number comes in a little bit better than expected, that could continue to add fuel to the fire around the market rally that we're seeing.
Is there anything specific, though, Michelle or Stephen, that you guys are looking at in terms of within the number, rather than just the headline numbers, but within the number that you think may be telling? Michelle?
Well, you just had the chart up for the percent of unemployed that are on temporary layoff. And we talked about that last month, and I will again watch that very closely. When you think about the massive number of unemployed, the expectation for the unemployment rate to approach 20%, the one silver lining is that the bulk of those at the moment believe that they will be called back to work within 6 months. That's why they're classified as temporarily on layoff. And I do think that's important. Whether or not all of those workers will indeed be called back to work, I understand is an open question. But to watch that number to get a sense of, again, looking forward, how long these elevated unemployment rates numbers may stand, I think will be something a lot of us will pay a lot of attention to.
Hey, Stephen, you talked about the market going higher if you thought that this number was even a little bit lower. Your expectations, the market's going to go higher anyway, no?
Yeah, we think the markets can continue to climb this wall of worry. And I think, in fact, what we've seen over the last week or two is a shift to a new phase of the recovery. The first rally that we saw was really a policy response rally. So $20 trillion of fiscal and monetary stimulus around the world cut off some of the tail risk around market liquidity concerns that we saw back in March. What we're seeing over the last week or two is a shift to greater optimism about a potential recovery and return to growth. That's why I think you've seen this rotation into some of the more cyclical parts of the market. We're seeing new leadership take hold. And despite the fact that markets are up plus 30+% since the bottom, investors are still very cautiously positioned. You have $5 trillion sitting in money market funds earning nothing. And as long as we don't see a pickup, a second wave, as long as we continue to see some of the recovery that we're seeing gradually in the real-time data, I think that money is eventually going to continue to come back into the market, and that can push us higher.